When you think of a recession, you might picture financial turmoil, but what if I told you it's just a hidden gold mine for the savvy investor? Well, 2024 might just be that season. It might be a year that's rewriting the rules of financial growth amidst economic challenges. So, in today's video, we will explore how this recession, unlike any other, holds the key to safeguarding your finances and significantly multiplying them. We'll delve into strategies that turn economic downturns into launch pads for wealth, uncovering methods that the financially astute are using now. So, how do these strategies work in real life? And can they turn the tides of a recession in your favor? Well, let's find out. A recession is typically characterized by a significant decline in economic activity across the market, lasting over a few months. It's visible in GDP, income, employment, manufacturing, and retail sales. The 2024 recession, like its predecessors, is not just a period of economic challenge, but also a time of reshaping economic landscapes. Several indicators have signaled the approach of the 2024 recession. These include a noticeable slowdown in economic growth, rising employment rates, and decreased consumer spending. Moreover, the key sectors like manufacturing and services have shown reduced output. Global economic factors such as geopolitical tensions and trade disruptions have also contributed to this downturn. What sets the 2024 recession apart is its context. Emerging from a period of global upheaval, including the aftermath of a pandemic and significant technological shifts, this recession is occurring in a uniquely transformed world. The rapid technological advancements and changes in consumer behaviors have altered the economic landscape, making this recession different from previous ones. While recession often carries negative connotations, it's crucial to understand that it's a natural part of the economic cycle. Historically, recessions have served as reset periods, clearing out inefficiencies and paving the way for new growth and innovation. For the astute observer and prepared investor, this period can present unique opportunities for wealth creation. So, what can you do? In the throes of the 2024 recession, the stock market has entered a bear phase, characterized by falling prices and often pervasive pessimism. Historically, bear markets have been seen as foreboding but also present unique buying opportunities. The key is understanding that market downturns are temporary and often followed by robust recoveries. Many stocks are undervalued during a recession, creating a buyer's market. This is the time to look for fundamentally strong companies with solid balance sheets, good management, and sustainable business models. These companies are likely to weather the economic downturn and emerge stronger. Recession-resistant sectors like healthcare, utilities, and consumer staples often provide safer investment havens. One effective strategy during volatile market periods is dollar cost averaging. This involves regularly investing a fixed amount of money, regardless of the market's condition. This approach can help investors avoid the pitfalls of trying to time the market and reduce the impact of volatility on their investments. It's crucial to maintain a long-term perspective during a recession. Short-term market fluctuations can be unsettling, but historically, the stock market has always recovered and trended upwards over the long term. Investors who stay the course and maintain their investment strategy during downturns are often rewarded when the market rebounds. You should also understand that risk management is key in a bear market. So, by diversifying your portfolio across different asset classes and sectors can help mitigate risk. It's also important to reassess your risk tolerance and ensure that your investment choices align with your long-term financial goals. Beyond the stock market, there's another world where the recession creates unique opportunities: real estate. The 2024 recession has shifted the real estate market, with predictions leaning towards a decrease in housing prices. Rising interest rates, economic uncertainty, and changes in consumer sentiment influence this trend. However, it's important to note that real estate markets are highly localized, and impacts can vary significantly from one region to another. In a recession, the real estate market often sees a slowdown in sales, leading to an increase in inventory and more negotiating power for buyers. This scenario can create lucrative opportunities for investors. Properties may be available at lower prices, offering the chance to purchase real estate assets at a discount. Investors should focus on areas with strong, long-term growth potential, considering factors like job market stability, population growth, and infrastructure development. While the value of properties might decrease, the demand for rentals can remain stable or even increase, as people might be less inclined to buy homes during economic uncertainty. This presents an opportunity for investors to acquire properties to rent out, potentially securing a steady income stream. Rental properties in recession-resistant areas, such as near essential services or stable employment centers, can be particularly attractive. But understand that investing in real estate during a recession requires thorough due diligence. As an investor, you should conduct a comprehensive market research, assess property conditions, and understand the local real estate laws and regulations. It's also crucial to clearly understand your financing options and the long-term implications of any investment. While tangible assets are key, there's an often overlooked player in recession strategy: cash reserves. Unlike other assets, cash provides liquidity and safety, two highly valued commodities during economic turmoil. It offers a buffer against market volatility and unexpected personal financial needs. Holding cash during a recession can be a strategic move. It allows investors to exploit market downturns and invest in undervalued assets. When prices of stocks, real estate, and other investments drop, having cash on hand enables quick action to seize these opportunities. This agility can be a significant advantage in a fluctuating market. In a portfolio, cash acts as a risk management tool. It reduces overall portfolio volatility and safeguards against liquidating other investments at a loss during market downturns. This is particularly important for those nearing retirement or with shorter investment horizons, for whom preserving capital is as crucial as growing it. While holding cash is beneficial, balancing it with other investments is essential. Excessive cash holdings can lead to missed opportunities and inflation risk, as cash typically generates low returns. A portfolio's ideal proportion of cash varies based on individual risk tolerance, financial goals, and market conditions. Building cash reserves can be achieved through regular savings, cutting back on non-essential expenses, and reallocating portions of a portfolio into more liquid assets. Planning how and when to deploy these reserves is essential, aligning with one's broader investment strategy. Now, cash reserves are crucial, but so is your primary source of income. Let's delve more into it. In the midst of the 2024 recession, career and income stability will become paramount as economic downturns often lead to job market contractions, making job security a top priority. Enhancing job stability is crucial, involving continuously upgrading skills and knowledge. Embracing learning opportunities through formal education, online courses, or on-the-job training is essential. Specializing in high-demand areas or gaining expertise in emerging technologies can significantly boost job security. Building a solid professional network is more crucial than ever, as it can open doors to new opportunities and provide support during industry downturns. Key strategies include engaging with your industry community, attending professional events, and maintaining an active presence on professional social media platforms. And by being adaptable and open to change, it can make you an invaluable asset to your employer. This might mean taking on new responsibilities, adapting to new technologies, or being flexible with changes in the workplace. Relying on a single income source can be risky, especially during a recession. Developing side hustles can provide additional income and a safety net. This could be anything from freelance work to online businesses to part-time jobs in different sectors. Exploring avenues for passive income is also beneficial. This could include investments in stocks or real estate, creating digital products, or other ventures that require an initial effort but can generate ongoing income. And while doing that, make sure to tighten your budget and increase your savings rate. Focus on cutting non-essential expenses and redirecting those funds into an emergency savings account. Aim to build an emergency fund covering at least 6 to 12 months of living expenses. This fund acts as a buffer against potential job loss or unexpected expenses, providing financial peace of mind. For some, a recession might be the right time to start a business. You know why? Economic downturns can open up niches in the market and reduce competition. If you have a viable business idea, this could be an opportune time to explore entrepreneurship. With career strategies in place, let's broaden our horizons. The principle behind diversification is simple. Not all investments will react in the same way to economic events. By diversifying, you're not putting all your eggs in one basket. Instead, you're creating a balanced portfolio that can withstand market fluctuations, better than a portfolio concentrated in one area. This balance is crucial during a recession, as some sectors and asset classes can be hit harder than others. One key aspect of diversification is the inclusion of different types of assets. This can include stocks, bonds, real estate, commodities, and cash. Each of these assets behaves differently under various economic conditions. For instance, while stocks may decline during a recession, bonds often perform better as investors seek safer investments. Real estate and commodities like gold can also provide a hedge against inflation and currency devaluation, which are common concerns during economic downturns. Another essential factor in diversification is geographic spread. Investing in markets across different countries and regions can protect against localized economic downturns. For example, if the 2024 recession is hitting the United States harder than Europe or Asia, having investments in these regions can help balance losses incurred in the US market. Understanding diversification leads us to the final piece of our recession puzzle: timing and market psychology. The concept of market timing revolves around making investment decisions based on predicting future market movements. In theory, it involves buying assets at their lowest prices and selling them at their peak. However, timing the market is incredibly challenging, even for seasoned investors. The 2024 recession, like all economic downturns, brings a high degree of uncertainty and volatility, making accurate predictions nearly impossible. The key takeaway is to focus on something other than timing the market perfectly, but to recognize and act on opportunities as they arise. This approach is about being observant and ready to move when the right opportunity presents itself, rather than attempting to predict the exact right moment to buy or sell. Market psychology refers to the overall sentiment and behavior of investors in the market. During recessions, fear and pessimism often dominate, leading to rapid sell-offs and sharp declines in asset prices. Conversely, excessive optimism in good times can lead to inflated asset bubbles. Understanding this psychology is crucial because it drives market movement more than fundamental economic indicators. Recognizing the signs of fear and greed in the market can help investors avoid emotional decision-making and capitalize on the overreactions of others. One of the biggest challenges during a recession is managing your emotions. It's natural to feel fear during a market downturn, but making investment decisions based on these emotions can lead to poor choices, like selling assets at a loss in a panic. Similarly, overconfidence during market recoveries can lead to taking on excessive risk. Successful investing during a recession requires a disciplined approach, sticking to a well-thought-out investment plan, and avoiding impulse decisions driven by short-term market movements. So, what's your strategy for turning the 2024 recession into an opportunity for financial growth? Comment down below. And don't forget to leave a like, subscribe, and turn on the notification bell. Thanks for watching, and I'll see you in the next one.